How's it, guys? Welcome back to the channel. Thank you for tuning in. Please take a moment to like and subscribe to the channel. So guys, in today's video we are going to be um, talking about the individual trading sessions. So I just want to make a quick video and show you how the individual trading sessions are interrelated and interconnected with each other, and how you can do that, how you can take advantage of that in your trading, right? Okay, so we're going to be looking at um, pound for this video. So I'm looking at Tuesday of this trading day, right? The reason I'm looking at Tuesday is because um, starting any trading week, the best day to trade is Tuesday. So Monday, you know, see what Monday does. In this On this day, we can see Monday creating this fair value gap there. Tuesday, when we open, we find some support at the midpoint of the fair value gap, the consequent encouragement of the fair value gap. You can see price finding multiple support there. Eventually towards. So this was a very slow London session for this day. As you would know, the new day indicates the London Open, and then 5 a.m. New York time, that's London lunch. That's London lunch. So in the London lunch, you're not doing much trading. You're not doing much trading. You expect no movement during the London lunch, or very little movement. For this day, during the London lunch, we had, so the London lunch started here. And then we saw some buy side price delivery. Price create this fair value gap there. Trace to it, they're using this candle. Trace to it using this candle, and then price is higher. And then we can see price then reversing, sell side price delivery. We can see this bearish fair value gap that gets traded to using the high of this candle. So let me just visually show you this fair value gap that gets traded to the. It kind of confirms that price is in a sell program. It's delivering what? Sell side price delivery, meaning it's delivering lower prices. It's going down. So we can see price delivering sell side price delivery and taking what? Sell side liquidity below the swing low formed right at the London lunch. So we can see that low being taken out there. That's sell side liquidity. In other words, when price was going up, the traders that were buying this, in order for them to put a protective measure, they would put a stop. They'll put a sell stop to protect the buy position they're in. So those sell stops below previous lows, we call that sell side liquidity. So sell side liquidity gets taken out there. We have a swing high that gets formed right before 7 a.m. 7 a.m. would indicate the algorithm changing from London to New York servers, right? Think about it like that. So we have, prior to 7 a.m., we have this swing high that gets formed there. Prior to sell side liquidity being taken out, we have this swing high. This swing high, the high of this swing high gets taken out right there using this candle. Remember, for a market structure shift, it doesn't need to close above. So it gets taken out right there. As soon as that's so, we have a swing high that gets taken out after sell side liquidity has been taken out. We check to see in that leg in that movement that takes out the swing high is the displacement. Displacement means magnitude. So how you can confirm magnitude, aka displacement, you would need to identify a favorable gap. We have a favorable gap here. So that confirms that there was displacement in this move that took out the swing high there. So that is a valid bullish market structure shift. So it gets the market structure shift gets valid from here. Then the very next candle doesn't do much, just trace back to this order block and closes here. Then the very next candle, where does it go? It opens here, go down to print the low. What it's actually doing is that it's trading to this fair value gap to confirm what? The market structure shift. So it trades to this fair value gap. Smart money is buying that. And then what does it do? It goes up to close higher. Can you see that it closes higher? More importantly, it closes above this old inversion fair value gap. So there's separation between these two candles. Between these two candles, the separation there. Normally, you would want to sell that. So if you're not selling that, if you see price closing above, that's an inversion fair value gap. So it's no more a fair value gap that you'd sell. It's an inversion fair value gap that you would now buy. So it's no more a CB that you would normally sell. It's a CB that now you would buy, because once it closes above, it's telling you that it's willing to go higher. So it closes above there. It does retrace a bit, but it closing above there is a signature that, the next move is going high. It's going to continue going higher. So this is just a small retracement. So it continues to go higher. Where is it targeting? Buy side liquidity. When price was going down there, delivering lower prices, there were traders that were selling this. So when they're in a sell position to put their protective measure, when they put a stop loss on their sell position, that is a buy stop. So they put a buy stop above this high, because every book teaches everyone to put a stop loss above the previous high. So they feel very safe putting the stop loss above that high. So that stop loss on a sell position is called a buy stop. So that's buy side liquidity. So you target buy side liquidity there. So we have a valid market structure shift. After liquidity has been taken out, you trace to the fair value gap, you target liquidity. What time is that happening? It's happening during the New York kill zone from 7 a.m. to 9 a.m. That's the New York kill zone. The New York session, however, it's far longer than that. So the kill zone is from 7 a.m. to 9 a.m. That's the New York kill zone. So after price takes out buy side liquidity, after price takes out buy side liquidity above this high, what does it do? It prints this fair value gap, this CB. I have taught this TUP. So that's a balanced price range, but I didn't plan on teaching it or talking about it for this video. So it creates this fair value gap. We have a swing low there after buy side liquidity has been taken. So buy side liquidity has been taken there. We have a swing low here that also gets taken out. Now when this swing low gets taken out, we check to see, was there displacement in the move that took out the swing low after buy side liquidity or opposite end of liquidity was taken. How do we check for displacement? Displacement is basically magnitude. So in order for there to be magnitude, there has to be what? An imbalance. Imbalance meaning fair value gap. So you can see this fair value gap. This fair value gap confirms that this is a valid bearish market structure shift. So this one was a bullish market structure shift. Now this is a bearish market structure shift. This one confirmed that price is in a buy program, hence you saw buy side liquidity being targeted. This one confirms that price is in a sell program, hence we will see sell side liquidity being taken out. Basically, price will deliver lower prices. Can you see that after that price takes out the swing low there for a bearish market structure shift, price does not take out any high anymore. Only lows are taken out, like this high left standing, this high left standing, you know. So from, I taught this, I made a video on this. I'm looking at from the swing high to the swing low formed between 8:30 and 11 a.m. Where is 8:30? Here is 8:30. Where is the swing high formed at 8:30? It's this one. It's this swing high here. This high that has a lower high to the left and a lower high to the right. That's a swing high. So we're comparing the swing high and the swing low, a low which has a lower low to the right and a lower low to the left, form in between 8:30 and 11. Here is it there. We're looking for a retracement into the 62. You can sell 62. We're looking for a retracement into the sweet spot, the 70.5. That's where you get your sniper entry. On this day, it trades a little bit above, but it does not trade to your stop loss. It trades above, a little bit above your sniper entry at 70.5 and a little bit above 79. On a normal day, you will never see 79 being traded to. And most importantly, your stop loss above the swing high there, that will never get traded to. So from the swing high to the swing low, formed during the New York session. So from 8:30 to 11 a.m., you're looking for a swing high and a swing low to be formed. Then you're looking for a retracement into the 70. You're selling the 70. Look at the bodies. The bodies tell the story. The wicks, they do the damage. Can you see that the bodies are staying below 70.5? That's not a coincidence. So the bodies are staying right below your entry. That's not a coincidence. It feels good to be in such trades, guys. So you enter there to 70, eventually price, it goes multiple times in your direction, right? So guys, I'm quickly rushing to show you the next example that I have here. So I'm looking at the following day after that. So we're still on Tuesday, but now we are looking at the agent session. So it's Tuesday, 8 p.m. What does price do? Remember that price was bearish from yesterday's, not even yesterday, from the morning, from the New York session in the morning, price was bearish. So even at 8 p.m. during the agent session, fair value gap, we can see fair value gap manifesting in price there. It gets traded to. Can you see that the bodies are staying below the fair value gap? Can you see that the bodies are staying below the fair value gap, within the fair value gap? Price runs away from the fair value gap. Wednesday. This is a new day, Wednesday, at 12 midnight. So that's when the algorithm will recognize that now it's a new day. The new true day that the algorithm will recognize. It's 12 a.m. midnight. So on Wednesday, 12 a.m. midnight, what do? Well, we continue with the narrative that fair value gap traded to, it continues lower. Can you see how they are interconnected? These consecutive candles, that's an order block. So an order block is not just the last does not close candle like they think so in retail. These consecutive candles, all three of them, that's one order block. These two candles, those are an order block within these three consecutive candles. So that's one order block. It gets ready to there and then gives out the gold. Okay, so this is a cutscene. I'm continuing from where I left because I got disturbed. So, like I said, it gives up the ghost and then it drops lower. Where does it go? Below sell side liquidity. What does it do after taking out sell side liquidity? After sell side liquidity has been taken out, um, after sell side liquidity has been taken out, the price. Can you see price closing up? So this is a model I'm teaching. I'm teaching you a new model. After sell side liquidity has been taken out, there you wait for price. On whatever time frame you're looking at. So I'm looking at the 5 minute. You wait for price to close above the low. Does it close above the low? Here, yes it does. You wait for a favorable gap to form. Does it form a favorable gap? Yes it does. Then you buy the favorable gap. Here's the favorable gap. You can buy the favorable gap. You can buy it immediately there when it touches stop loss below the candle that forms the favorable gap, or below the swing low that just got formed now. The stop loss below the slow. Does it trade to it? Not after it takes that what? Buy side liquidity. There. Can you see that? So that's narrative. When you're new, you'll be buying here the favorable gap. I'm not new. I can buy right at the consequent encouragement, the midpoint of the favorable gap. I won't be trading during London lunch. London lunch, I don't trade during London lunch. This is just a model that you can maybe try look for it in during important time of the day, right? Not during London lunch. Anyway, but on this day you can see it being manifesting during the London lunch. Anyway, 7 a.m. New York session starts. Consecutive candles, pot traction stage, bearish order block. We have a swing high that forms there. Remember, we are bearish. Remember, Asia was bearish. Yesterday was bearish. London was bearish. So what are we anticipating now? Bearishness. So when we see these consecutive candles, we think that is what we want to see. We want to see a post-traction stage. We want to see a Judas move. Swing high there, smart money reversal. Does this candle take out the high there? Does this candle take out the high of this candle? No. That confirms that this is a smart money reversal. What is that? That's a green candle. Smart money reversal means that we are bearish. We're in a sell program. It's the first stage of smart money traders that are going to be selling this. Smart money reversal. So if we're in a sell program, the green candles are bearish order blocks. So when we trade above that, when it trades back to it, smart money traders are selling that bearish order block for a low risk sell. They're selling there, it goes down, comes back, they're not scared to sell again. Low risk sell. Why is it low risk sell? Because the stop loss is above this swing high. It's not far. That's a lot of small movement. So they call it low risk sell. These guys, smart money reversal, they're very smart, so they can see the reversal there. After them, low risk sell. After them, first stage distribution. If we're in a sell program, the green candles are bearish order blocks. So these two consecutive candles, those are a bearish order block. Those are one order block. It's not the last one, not those candle, guys. An order block, here's your notes. Here's for your notes. An order block is simply nothing more than this. An order block is simply a change in the state of delivery. Price is in a sell program. So when price changes its state of delivery and delivers buy side price delivery here. In other words, green candles. When it prints green candles, and when it prints green candles, immediately when it trades below the green candles, the low or even the open, immediately when it trades below that, that becomes a change in the state of delivery. Price was delivering buy side, now it's continuing delivering sell side. So when it goes back to the price to that point, that's a bearish order block. First stage distribution. The first trader enters there, the second trader enters there, the third trader enters there. These consecutive candles, I told you that's one order block. Another trader could be selling that stop loss, same stop loss as his model says. None of these traders get stop loss hit. Why? Because they're all trading with logic. Or guess what? All this can be you. You can enter the first trade day, second trade day, third trade day, fourth day, as many as you want. If you trading, if you just learn this the right way, right? So second stage, give up the ghost, break low, fair value gap. When we trade back to that, that's a bearish fair value gap. Second stage, redistribution. First stage distribution, second stage redistribution. It's always going to be the quickest move. This is ICT's personal trading. So when ICT opens a trade, he likes to open this exact move here. He doesn't like first stage, doesn't like low risk, doesn't like smart money reversal. He likes this one here. The fastest elevator ride you're ever going to be in. It's called the ICT unicorn. Second stage redistribution. One of the deadliest, quickest moves you will ever be in. And it happens each and every time. This is part of the market maker sell model. So it breaks lower, fair value gap again, straight back to it, breaks lower. Now what time is it? 10 a.m. London close. So the London close is a period of time where we expect the low of the day to be formed if we are bearish. So if we had a sell day like this, where can we expect the move to be complete? It can't just go down forever. Where could we expect that now we are done with the move between 10 a.m. and 12 a.m. during the what? London close. That's to expect the low of the day to be formed if we're bearish and the high of the day to be formed if we are bullish. We have a low here that gets formed at 10:35 after 1, 2, 3. What is that? 3 drives pattern. I made a video on it on the channel. Like the reason I don't make videos on too many concepts is because I like to keep it simple. That's why I keep on talking about the same things that even I trade. You see, I'll never teach you a model that I don't even look at. So all the models that I'm teaching, I know them in and out because they are my own personal trading models. You see, 1, 2, 3, smart money reversal. So pretend that you're not around when all this was happening, right? Pretend that maybe you're busy, you're working or you're studying, you're a student, you're busy during this time. You're only free from 10 a.m. to 11 a.m. to 12 p.m. New York time, right? So you're only free in this period of time. How you can do that is that if you haven't maybe opened any trade for the day, you still haven't opened any trade, rather wait for 10 a.m. If you saw that, early New York, we had a bearish price delivery, we had south side price delivery. At 10 a.m. to 12 a.m., anticipate the opposite happening. In other words, anticipate a reversal. So when you see 3 drives pattern like that, anticipate this being a smart money reversal. Anticipate this being a smart money reversal. We have south side liquidity taken out below this low here. We have a swing high that gets taken out. There is no fair value gap, but there's an order block here that you can buy. How's that? So it's not always order blocks that you're trading. It's not always fair value gaps. There's order blocks that you could be trading. Price goes higher.